There are 4 common mistakes to avoid when you're buying a house. And if you don't know who I am, my name is Meredith Silk. I'm the owner of Silk Mortgage. I've helped hundreds finance real estate, and I'm on a mission to make the home buying process smooth and simple while offering the best rate guaranteed. So let's get into it. Okay, so number one, you don't want to talk too much during a showing. And think about it, most homes nowadays, they have security systems. They have ways that they can hear what you're saying inside the home and also see while you're in the home. So you don't want to say anything negative at all. Now, I personally made this mistake one time, and I believe that it cost me the offer on the home. So you don't want to do this. Also, don't share anything about the offer that you're going to be putting in. Don't share anything about your personal finances, because you don't know that could be used against you when you go to put an offer in. So number two, acquire new debt. So you don't want to take on any new car payments, furniture, credit cards, anything like that, because that can negatively impact. It can lower your pre-approval amount and also your credit score as well. And to put it in perspective, if you add on, let's say, a $400 car payment, that can lower your pre-approval amount almost up to $90,000. So it's a huge hit. And the reason is lenders really care about your, we call it debt to income ratio. So how much debt you have versus how much income you're bringing in, because the number one thing, they want to make sure that you have enough money, the ability to make your mortgage payment so that you do not default on the house. And so if in any case, if you're in the pre-approval process and you have to get a new car or something happens and you must acquire new debt, make sure you talk with your lender beforehand. So number three, a change of pay structure. So if you're going from salary to commission, salary to hourly, W-2 to 1099, or if you're self-employed and you open up a new business, this can cause a loan denial. And the reason is banks have very specific guidelines on how they calculate income, so you have to be extremely careful if you have any pay structure change. And I will argue all day long, income is one of the most important components in a mortgage loan. And the reason is it's also the hardest to fix. So you can fix your credit score, you can pay off debt, you can save up money, but income is really hard to change. So if you have a change in your pay structure, it's important to tell your lender up front so that they can come up with a plan for you. Number four, cash deposits. Now, the banks do not like cash. Everything must be sourced per the government, per the Anti-Money Laundering Act. So you want to make sure that if you do have true cash, like mattress money, put it in the bank now, because it must sit there for 2 months. And the reason is once you go into underwriting, they will only look at the last 2 months of bank statements. They will go line by line. So if they see any cash deposits, they need to know where that cash came from. You need to provide receipts and the source from it for you to use that towards your down payment and closing costs. Even if you have wire transfers, you must prove where those wire transfers came from. And if it came from another bank account that you have, you must provide the last 2 bank statements from that as well. Also, gift money for family members. You can get a gift to use towards your down payment, but especially if you're doing a government loan, that person must sign a letter and also provide the last 2 months of bank statements from them. So it's important. Plan this out now, and if you have any questions, reach out to your loan officer. It's important to start the planning process now. So I hope you found this helpful. Consider subscribing. I'll see you on the next one.